Hello from Hong Kong and welcome to this week's market update. Earnings week gave us some blockbuster numbers. Apple, Facebook and Alphabet all beat expectations by a wide margin. Apple's revenue soared nearly 54% from a year ago to $89.58 billion, far better than analysts' expectations. Earning per share of $1.40 topped estimates of 99 cents. The stock reaction, though, was muted. Now, Goldman Sachs admitted it was wrong on Apple after downgrading the stock in April 2020 to sell. It changed its tune, upgrading the stock to neutral. Social media giant Facebook gained more than 6% after reporting first quarter revenue of $26.17 billion, a 48% increase compared to a year earlier, thanks to pricier ads. Facebook proved it has pricing power with advertisers unfazed by cost increases. Google parent Alphabet also benefited from a surge in advertising revenue, and its stock jumped more than 5.5% this week. Despite strong earnings, though, inflation and higher rates are keeping enthusiasm in check. The market was broadly expecting good news on earnings, along with Fed support and a great GDP number of up 6% in the US. With more borrowed money on the table from the Biden-Harris administration, the market seems to be defaulting to sell the good news. Now, as I wrote in a piece earlier this week, a sell in May and go away mentality could kick in after earnings season concludes. Now, there are a few reasons why this might occur. Volume could fall as investors look to do other things as the economic reopening continues and summer approaches. In addition, the fear of capital gains tax rises in the US may make investors wary of waiting much longer to bank some impressive returns. This thesis is further supported by retail and investment advisor sentiment cooling from extreme bullish readings over the past week. This, according to CNBC's Rick Santelli, is likely a reflex and not a wholly rational response to the capital gains tax hike chatter. The NIME survey ramped exposure back up to leveraged long, which signals that investors are close to all in this market. Now, we've seen this a handful of times since the COVID crash, and except for August, it has largely preceded a flattening out or modest pullback, not a lasting downturn. As always, Akuma and AMC Private Wealth encourage a diversified portfolio. Now, finally for this week, China will crack down on the financing arms of its tech giants, with Tencent and ByteDance among the names likely to be affected. Now, regulation can be viewed as a bad thing, but in my view, regulation is put in place to ensure stability. Now, whilst fines and restrictions may cause some short-term bumps for the tech giants, it is likely a drop in the ocean when compared to their revenue, but may dent the future value of any IPOs. Now think Ant Group, which will now be subject to the same rules and regulation as banks. That's all for this week's market update. I will see you all again next week.